Hello and welcome. You're watching All About Your Company here on ET Now, and I'm Harsh Saita. Today we're going to be talking about BlueJet Healthcare, and it's interesting because the stock has fallen sharply. There's a very large upside that analysts are building in, and there are some top analysts from top brokerage houses having a very strong call with regard to this one. But it was a very weak Q2. Can the turnaround likely play out starting H2 FY26, or is it slightly more delayed? What to make with regard to growth, and how should one pencil in growth? Customer concentration is the other big angle. But let's talk about first what I want to know. The status check with regard to both inventory as well as margin rebound, and this is in particular on pharma intermediaries. That's one of the verticals that BlueJet does. Around 50% of its top line comes from there. The second one is Q2 growth. Is it likely to come through in Q3? Because there's been a large drag in terms of that growth number in Q2, and we'll look at the H1 numbers and you'll get a better perspective of that. Third, contrast media. Is there a recovery at play there? Are we going to start to see more diversification in terms of revenue stream coming in from contrast media? That's the other piece that I'd want to know. Fourth piece is with regard to new molecules as well as growth levers. What is in store going forward with regard to the growth pipeline? Fifth is with regard to margins sustainability. They've done fairly well with regard to margins, but on the pharma ingredients side of things, they've got the margins, the gross margins have been volatile. So I'm wanting to get a sense of where that goes and why that is so. And second, whether on the overall EBITDA margin number, can we see a sustainable 35% type? Let's look at also the last piece, customer concentration. Top 5 clients contribute nearly 80% of the top line for the company. That is a risk, and a very real one. So we'll try and understand how the company is diversifying that risk. Now let's talk about the company first off. It's a specialty pharmaceutical intermediaries manufacturer, focuses on contrast media, and I will explain contrast media in just a bit. Sweeteners as well as pharmaceutical intermediaries. They were established in 1968, so have a long history, and they have a CDMO model with innovators as well, which isn't doing particularly well. We'll have to see how the uptick comes in, but they have that as an option in terms of growth, a lever for growth, if I can call it that. Now let's talk about the products. Contrast media intermediaries. What are these? They are basically chemical agents which are used in medical imaging visibility, which is typically for your MRI as well as your CT scans. They help to ensure that the scans come out clearer and cleaner. And these are used across the world, of course. Second is high intensity sweeteners. What basically this does is, with a very small quantity of sweetener, it is able to give you a very large amount of sweetness, and therefore they are basically nothing but chemical agents like saccharin or salts, and they are used in foods like stevia, right? Now the third one is pharma intermediaries, or APIs as you typically call it. They are nothing but the building blocks for chronic drugs, and basically they are the absolute raw ingredient which is used, or which allows for the impact of medicines on your body, and that's basically API. And it includes the API segment itself within BlueJet Healthcare also includes CDMO, which is the specialized version or specialized drugs which allow innovators to manufacture the drugs that they manufacture. Let's talk about the product mix and the breakup. 50% comes from API, 35% from contrast media, and high intensity sweeteners contribute roughly 15% to the top line. Exports is around 87% of the top line, and revenue comes from 50 plus countries. Domestic is just about 13%, so large reliance on export. France and Norway are two of the top destinations where they export. In terms of the manufacturing facilities, there are 4 manufacturing facilities which they have, and they operate out of Maharashtra. Let me talk about the one key concern. The top 5 clients or customers contribute 80% of the top line of the company. I spoke about this, which is a key concern. Now let me talk about the P&L account, and let's quickly look at the metrics. You look at revenue, which has grown at a 15% CAGR over the last 3 years. You look at the EBITDA number, that also has compounded at a healthy 15% over the last 3 years, but it's been choppy, as you can see. And you look at the net profit, it's gone up by 19% over the last 3 years, but a large part of that growth has actually come in FY25, if you see. So you're seeing clear choppiness across the board, but nonetheless, we've given it a thumbs up, just given the fact that compounding has continued. You look at the revenue number, it's grown at 40% for H1 FY26, and you're looking at a very, very low base, and therefore that kind of growth, and a large part of that growth has actually come in Q1. Q2 has been extremely muted. EBITDA has also gone up, margins have also inched higher, and net profit has also gone up in H1. But Q2 has been particularly weak in terms of the quarter. Let's look at operational metrics, and you can see that on your screen. Anything between 30 to 36% is what it typically clocks, but again, that choppiness is visible. We've given this a thumbs up nonetheless, because 30% plus margins is surely solid. And mind you, some of these contracts are slightly long gestation, just about 5 years in terms of our understanding. But we will ask management as well as to how these contracts are structured and what the margin could well be and what the risks to this margin number could well be. Now let's talk about the balance sheet. Again, no concerns there. You look at the book value, it's at around 1300 crore. The market cap of the company is around 9,100 crore, so basically it trades at around 7 times in terms of price to book multiple. And you look at the cash bank, it's looking fairly decent. 200 odd crore sitting in the cash bank account. There's absolutely no borrowing on the balance sheet except lease liabilities, which typically we exclude for the purpose of computing debt, and therefore we've excluded that. It's a zero debt company, and therefore no concerns there. But where is there a concern? It's the cash flow. The conversion hasn't been happening, or again, it's choppy. The receivable days have gone up substantially. Want to understand as to what's playing out. Inventory days have gone up, working capital days have gone up substantially, but nonetheless, your ROCE numbers reflect an okay picture. You're looking at ROCE of roughly 40 odd %, which is not bad at all, despite all that is playing out. Now let's talk about the shareholding pattern. When you're looking at the shareholding, promoters hold roughly 80% of the company. There could be some dilution at play here, of course, because there is no cash per se required in the business. But you're looking at FIDI ownership, which is inched up just a wee bit. Public ownership has gone up substantially. Some of this is because of the dilution that the promoters have done, 6% dilution, out of which 1.5% was taken up by DIIs. The balance 4.5% was diluted through an OFS. Both, in fact, was diluted, the full 6% diluted through an OFS, but a predominant part of that has been taken up by retailers, which is reflecting at the bottom line there in the public shareholding, and due to which the number of shareholders has jumped, and you've seen some bit of cool off on the stock price also since that point. But shareholding likely a positive. But what you need to understand is there will still be 5% dilution likely to comply with minimum public shareholding. Let me talk about valuations. Price to earnings trading at a 22 times 1 year forward, which is a 2-year low for the counter. So therefore looking interesting. The 2-year average is 32 times. And when you're looking at the implied profit growth over the next 1 year to arrive at that 22 times, there's a 20% profit growth which is being penciled in by analysts. Now let's talk about what the analysts are seeing. There are the likes of a Motilal, there are the likes of an Macquarie. So there are some decent analysts tracking this one, even though there are just 7 analysts tracking it. 5 buy calls, 1 hold, 1 sell. The 1 sell is an MK, which has a sell rating on the counter with a target price of 600. So an upside even from here, even on an MK, but nonetheless. And they have a return potential of 38% on the counter. Now the stock itself has fallen quite sharply. That is the snapshot of the entire picture with regard to a BlueJet Health. Let's quickly also slip into a break. On the other side, we'll have Mr. VK Singh, who's the COO of BlueJet Health, to come in and talk to us about those numbers and what we can expect going forward. Stay with us here on ET Now. Welcome back, and we're in conversation with Mr. VK Singh, who's the CEO of BlueJet Healthcare. We've just analyzed the company. Mr. Singh, it's great having you. Give us a perspective. How should one look at your company? Because we've seen even annual choppiness in terms of top-line growth. So I'm trying to understand as to what's causing that. Because while you're a CDMO player, you also have slightly longer-term contracts. So I'm trying to get to how should one look at a BlueJet Healthcare?
So, Harsh, I think you have dissected the numbers I was hearing while I was waiting to come on screen. So you have dissected the numbers very well, and the numbers tell a story. But then there's a story beyond the numbers, which I think I should speak about for the benefit of the viewers. We are a pure play CDMO. We are very highly regulated market focused. We are export led. Reg markets and export, they contribute about maybe more than 90% of the turnover. We are innovator oriented. All our businesses is towards the innovators. And we operate in a non-generic space. And like you rightly said, that most of the business is driven by long-term contracts. If you would look at the last 4 years, I think the top line CAGR has been about 25-26%. And we have maintained EBITDA margins in the mid-30s and PATs in the mid to high 20s. And we have been quite consistent in that. While you did mention a lot of information about the sectors, what I would like to just add to that is that all the three segments that we are in, contrast media, CDMO, API, PI, that's pharma intermediates, so the high intensity sweetener, we are seeing secular growth because of awareness and demographic tailwinds. Contrast media particularly, which is the flagship of the company or the mainstay of the company, that's segment, product vertical is sitting inside precision care or medtech. And that is a very interesting segment because of all the diagnostic growth and the new interventional radiology that's happening. And in the PI segment, the way we have approached the market, which is more towards a patented chronic space, we see good growth there also. High intensity sweetener, of course, is because of the health awareness that more and more people are migrating from conventional sugar to high intensity sweeteners. So all these are three, I would say, how should I say, sunrise segments with elongated product cycles. So if you look at contrast media, which is our flagship, you do not see any product obsolescence. And the market is very closely held by 4 or 5 big players, the very large multinational companies of the innovators. And they control about 75 to 80% of the market. Despite the fact that there are no patents, there are still no generics. People have tried, but they have not been able to enter the market because of the control that the innovators have and the drug device coupling. There's a huge element of drug device coupling. So I think the segments that we are all very solid. Our contracts are very solid. Our technologies are very well recognized. We are building capacities. While on the number front, you may feel that Q2 was tepid. The reason for that is that one of the cardiovascular opportunities that we were tracking with the innovator, which is still under patent, there was inventory buildup and there was some destocking happening at the client end. Because of the destocking, we did not have some orders. But then the end molecule is still doing very well. The prescriptions are rising to the extent of 40 to 50% annually. But we are the suppliers of the intermediate. Somebody makes the API, then somebody else makes the formulation, and the formulation goes to a distributor and then to the patient. So there's a 9-month to 10-month lag. So the traction that the end molecule is getting, that you will see getting reflected in our numbers, maybe in a couple of quarters from now, once again. So I think this third vertical will be the PI business will be getting back into where it was and showing similar growth. Besides, there's a real alignment of supply chain. And I cannot say more than because I'm protected by CDAs. Once the realignment of supply chain kicks in, I think BlueJet will again be one of the primary players in this particular segment.
So talk to us a little bit about that. The two pieces you just spoke about. One is the destocking. you're likely going to see that for one client. Because you've suggested this 25% growth clip that one ought to expect from a company your size, which is just about 10,000 crore, and the potential that you have, when should we start to expect a consistent 25%? Can we expect that, or is that choppiness always going to be there? That's my first question. The second question is with regard to those two risks you just spoke about, destocking and logistics. How do you see those environments shaping up, and when does logistics get better for you?
See, if you look at the last 7 to 8 quarters, in the numbers, I don't think you will see too much of choppiness. You will find significant consistency. So it's not that, we have degrown or we have, grown exceptionally or something like that. So I think as far as the CDMO business is concerned, there is an element of, people say, lumpiness, and that comes from the fact that we are a campaign-driven business, right? Since we are campaign-driven, that has to be there. If you will segment, slice and dice the data over a 3-year horizon or a 4-year horizon, you'll see a lot of consistency. It's not only about BlueJet, it's about any CDMO. Look at 3 years, then I would say that this top line CAGR of mid-20s, EBITDAs in mid-30s, and PATs between mid to high 20s. This is something that we are quite confident that we should be able to deliver. Beyond this, as a company policy, we refrain from giving immediate guidance. But while, Q2, the numbers may sound a little disappointing, but if you look at again, if you just look at H1, I think is is still quite good. I mean, the top line grew by about 40%. The profits grew about by 30-35%. So moment you look at H1, I think that's shown some very good numbers. Besides, Q2, personally, I would say has been very good and eventful, because this is the time when we have finalized our land in Vizag. We have taken about 100 acres. That land is now in our possession. Our asset turns have been in the vicinity of, let's say 3.5, 4-ish. We may not be able to maintain such asset turns going forward, but at Vizag, we envisage that over the next 7 to 8 years, we will invest about 2,500 to 3,000 crores. In the first phase, which will start maybe beginning of next year, we believe that we will invest about 1,000 crores in that first phase, mostly from internal accruals, because we have cash on the balance sheet. For Q2, while again, I would say that while you may feel the numbers were tepid, we have laid the foundation or signed off for a new R&D center at Hyderabad. For a CDMO business, you have two major pivots. One is capacity, the second is R&D. So we have acquired land in Q2. We have started work on a new R&D center. We are adding some new technology platforms. We'll be focusing on chiral chemistries, on some biocatalysis, on particle sizing. So certain new platforms will come up in Hyderabad. So I think this is the time when we are building for a very strong future. In addition to that, we have launched a new product on the iodinated side in contrast media. Last year, say about 2 quarters back, we had launched a new product on the gadolinium side. Now, on the gadolinium side, in the Q2, we have got some very good orders, and the order book is robust on the Gado side. On the iodinated side, while we have launched, maybe it takes another quarter or 2 quarters to get a solid order book. But then this ramp up will also happen because the client is already existing, and the product to which we supply the advanced intermediate is commercial.
Okay. Mr. Singh, give us the outlook with regard to working capital days. That's the other piece of your business where you've seen a bit of a drag. Where, at least at the end of FY25, working capital days were in around the 150-day region. What's caused the drag, and when can we see the unwind happen?
Harsh, see, in our business, when a new market opens or a new product is launched, there is a inventory built up by design. because when you enter a market, then what you try to do is that 40% of the annual requirement you have to put in the market. So there's an element of that. Each time there'll be a launch, there will be higher working capital that's going to get locked in. But you would see that our cash conversion cycle is quite good, and we have good cash on books. So I don't see that as a real concern.
Okay, and the promoter group still needs to sell around 5% odd. How quickly will that likely happen? Because that is the other piece which is keeping an overhang or a lid with regard to how the stock reacts. So I'm trying to get a sense whether there's a timeline in mind for that.
See, as per the rules, we have time till November. But then, as I mentioned, that Vizag, we have about 100 acres land, and that's going to be quite capital intensive. Um, so I think it's on our mind, it's on the cards, and within the stipulated period, we would be making the additional dilution.
Mr. Singh, a company will continue to remain debt-free and do ROCs of 35-40% because that's what you've historically done. Can we continue to pencil that kind of an ROC on the business?
I think, now that we are getting into a phase where the investments will be very large and very large capacities will get built up, while, there were two reasons for which our ROCs have been very high. One is that we have gotten into products which are, already commercial. And because of that, the ramp up happens very fast. The second is that normally we launch a product from a bridging capacity. And by the time the actual capacity is up, the product is up and running, and you just have to do a site transfer. We are trying to replicate the same model as we go to Vizag. And if we are able to do that, I think these ROCs and asset turns are too high. We may not be able to maintain them, but they will still be, one of the best in the industry.
My last question, Mr. Singh, is with regard to customer concentration. Will that likely, is there an attempt, an effort being made to diversify? Because top 5 contributing 80% is a huge risk.
So, Harsh, it's a very good question that you ask, and all your viewers and investors must be having some sort of concern around it. But, at the outset, you explained, and then I further corroborated the type of segments that we are in. For example, contrast media. It's a $7-8 billion market at the formulation end, at the market end. And it's dominated 80% or 75% is with just 4 players. So the structure of the market is such that you cannot avoid customer concentration. But then you also have to see that these customers are those who have been on the market for more than 100 years. I mean, I'm not going to name any company, but then if you look at the top 4 or 5, 3 or 4, not even 5, 3 or 4 companies in contrast media, they have been on the market for more than 100 years. So now if there are 4 customers and of them, one is a dominant customer who controls, 40% of the total market, then similar customer concentration will be reflected in our sales as well. And I would say that if the customer concentration of the market is getting reflected in our sales, this is not a risk. While we also identify it as a risk because that's the policy or guideline, but actually it's a strength. So we are not concerned at all about this customer concentration. I think all our customers are in the pink of health, and they are leaders in their respective categories, and the products are under patent. So we don't even have the fear of a generic competition. The question of customer concentration comes when there are 20 or 30 customers in the market, and you are with 1 or 2 of them, which make a big part of your portfolio. In our case, it's something which is completely different and structural.
Point taken, Mr. Singh. In fact, unfortunately, we are completely out of time on this edition of AAYC, but thank you so much for coming in and giving us that perspective with regard to the business. Complete pleasure speaking with you, and completely out of time, viewers, on this edition. Thanks so much for tuning in, and that's a goodbye from all of us here.